Here's how it all started. In 1952, Nicolas Darvas is paid $3,000 Canadian to dance. He's given 6,000 shares of Breland, that's Breland mining stock, worth 50 cents Canadian per share on the Toronto Stock Exchange. That's a TSE. 2 months pass. Nicolas discovers Breland stock is trading at $1.90 Canadian. He sells it for 8,000 Canadian. This yields a fast $5,000 Canadian profit. Nicolas Darvas writes, I decided I'd been missing a good thing all my life. I made up my mind to go into the stock market. I've never gone back on this decision. Nicolas knew absolutely nothing about the stock market. He made his first stock market profit out of sheer luck. He realizes that his big problem is how to start. He has no idea how to know what to buy. Darvas decides he must find more information. He decides as his first potential solution that rich people must know about stocks. He had a common problem. He asked wealthy people at the clubs at which he danced about stocks. Everybody did seem to know one, a good stock that is. Everybody had the secret. He bought stock in companies he could not pronounce. What they did and where they came from, he had no idea. Asking people, do you know a good stock, is a solution that never works, Nicolas Darvas decides. And he had a broker problem. Do you know a good, reliable broker? Nicolas is directed by a show person in New York to a financial dawdler with a broker's license. The statistical-minded Canadian broker recommends Eastern Malartic. He explains how the dividend stock is paying 4 times more than the cost. But he fails to mention that this is because he's held it for an eternity. He reckons they have gold mines capable of double the present production. So, the $2.90 Canadian stock should be worth $10 soon, according to his analysis. Nicolas eagerly buys 1,000 shares at $2.90 Canadian per share. The stock drops. He sells within weeks at $2.41. This is a $490 loss. Nicolas concludes that brokers do not have the answer to making a fortune in the stock market. His new problem is compulsive gambling. Darvas goes on following any tip, but seldom makes money. He has an ignorance problem. For instance, Nicolas didn't understand a thing about the way brokers' commissions and taxes worked. He buys 10,000 KRAN for 10 cents. The next day, KRAN goes to 11 cents a share. Nicolas reckons that he's garnered $100 fast profit in just 24 hours. But the problem is he doesn't understand the Toronto Stock Exchange. His Canadian broker explains that he's incurred a loss due to a $50 commission per half turn. That's $100 in and out. And additional transfer tax is applied. He jumped in and out of the market like a grasshopper, delighted to make just 2 points. A point in stocks is $1. Nicolas often owned 25 to 30 stocks at a time, all in small parcels during this period. He is way too spread out. He also develops an emotional problem. For some of his stocks, he acquired a special liking. Other times, it was because he started out making money with them. He started to keep pets. He praised their virtues day and night. He talked about them as one talks about his children. His pet stocks were causing him his heaviest losses. He was holding a lot of stock which slumped well below the price he'd paid for it and looked like it was staying there. His search for rising stocks unravels into hunches and wild guesses. Nicolas Darvas does not try to understand the stock trades he is making. He does not consider technical or fundamental factors during his Canadian period. He follows wild hunches entirely out of the blue. He follows stocks based on circumstantial meetings, rumors of rare earth, tales of the oil patch, or anything at all related to the stock market anybody happens to tell him. And just like chimpanzees who hit the food button more when payouts are random, an occasional gain gives him false hope. The stock gain is the carrot, lost opportunity was the stick, and he was the donkey. He loses $3,000 on bad stocks. He doesn't know what he's doing, but he feels ahead because he has his original $3,000. Investment advice subscription services made stock market investing sound so easy. Like 1, 2, 3. These services made such proclamations as, buy this stock now. Buy as much as you can. If your broker says no, fire your broker. Expect 100% or more from this stock. Such important sounding information sounded true. In fact, it sounded red hot. This had to be more reliable than talking with people in a hotel diner. The investment editors could read his mind. They knew how he felt and his condition. They wrote, a momentous moment for Canadian investors that Joe the plumber will finally be allowed in from the start. And the fat cats on the New York Stock Exchange have been trying to buy us out. But in thumbing our noses at them, we are opening the door to the little guy, folks like you. This pulled Darvas in. Nicolas was the little guy who needed help. He should have been helped by a shrink for his naivete, he thinks later. The stock each investment newsletter recommended generally went down. Darvas would urgently dash to his landline phone to buy a recommended stock, and it would drop. He wasn't worried, though. Nicolas was convinced that the investment newsletter editor knew what he was talking about. The guru was his friend and trusted, after all. The next recommended stock must rise. Stock recommendations seldom did. Over time, he figured out that when investment newsletters recommended stocks, professionals who bought in lower sold. Money that entered the market on newsletter tips was from suckers. The newsletter editor made his subscriber feel like the fastest with the most, but in reality, they were the last with the least. Retail investor money is too tiny to hold up stock prices once the pros begin selling out on a stock tip from a newsletter. But Darvas had no idea at the time. He just thought that it was bad luck that the investment newsletter recommended stocks tanked after he bought them. Nicolas Darvas is forced to rethink his trading plan from scratch. A year passes. He finds himself at the end of 1953. His 11,000 was down to 5,800. Head waiter stock rumors flopped. Wealthy business folks' tips tanked. Investment newsletter recommendations proved worthless. Darvas reads Barron's, the New York Times, and the New York Herald Tribune. He also reads the Wall Street Journal. He ponders mysterious jargon such as over-the-counter. He decides that the largest stock market on earth in New York is right for him. He sells everything. The only Canadian stock he holds is Old Smoky Gas and Oils. His 19-cent stock sells for 10. He sustains a painful 47% loss. A theater manager directs him to a New York broker. He gives him the fictitious name of Lou Keller in the book. And here's the cost of overtrading. Old Smoky Gas and Oils cost Nicolas a 47% loss. K-Ran Mines a 33% loss. Rexbar a 15% loss. Quebec Smelting and Refining a 36% loss. It's definitely time for Nicolas to step back and rethink what he's doing. In October of 1999, Professor Andrew Metrick of the New York University Stern School of Business published an important article in the #1 ranked Journal of Finance. This paper showed that the investment newsletter returns compiled in the Mark Hulbert Financial Digest exhibit lackluster returns, exactly as Nicolas Darvas discovered decades before. If you want to read this article, it's by Andrew Metrick, 1999. It's called Performance Evaluation with Transactions Data, the Stock Selection of Investment Newsletters. It's in the Journal of Finance, Volume 54, Number 5, on pages 1743 through page 1775. The negative alpha that Professor Metrick documented, which means that the newsletters actually lost money on average, was directly experienced by Nicolas Darvas. The desire to follow a newsletter came from Darvas's initial lack of confidence. As he grew into an intelligent investor, he learned to think for himself. And that is the primary mission of this course, to get you to think for yourself when it comes to your investments. But the bad news about investment newsletters doesn't stop there. I did a research piece with two prominent researchers. One is Eric Powers from the University of South Carolina. He holds a PhD from Massachusetts Institute of Technology. And the other is Jose Julian Cao, who holds a PhD in econometrics from Cornell. So there was a lot of brain power on this particular study. And in 2013, Georgetown University CFA Claire Emery wrote a digest summary of our article in the CFA Digest. Her work condenses Brown, Cow, and Powers Do Investment Newsletters Move Markets, published in Financial Management in 2013. We find that newsletter recommendations send a lightning bolt of volume into the market for the recommended stock. This drives the share price upward with the greatest strength in the first day. Volume and price impact dissipate for another 2 weeks of trading, but most of the impact is felt in the first 2 days. The stock gives up a lot of its initial gains over time. Jensen's alpha is slightly negative for the newsletter we study, despite short-term advances in return. Now, having roughly a zero Jensen's alpha is actually an improvement over the work that Andrew Metrick did, where he showed that on balance, all of the investment newsletters he looked at had negative Jensen's alpha.